It's the end of your forbearance. The bank's giving you your options. I'm going to go through the pros and cons of each. When the coronavirus started in early 2020, Congress passed a law called the Cares Act, which in part gave homeowners that had government-backed mortgages such as Freddie Mac, Fannie Mae, FHA, and the VA the option to go into a program called a forbearance. A forbearance basically is a suspension of payments for a specific amount of time. Initially it was 6 months, and then it was extended for another 6 months. We're coming to the end of 2020, and a lot of those forbearances are actually lapsing right now, and the banks are giving you options. The CARES Act did not cover non-government backed loans. However, many banks mimicked the CARES Act requirements and offered forbearances. The bank probably sent you a letter giving you your options. The 5 options that I've seen, and I'm going to list them right now, are: number 1, full repayment. Number 2, intermittent payment, which means paying over time, a short period of time, what you owe. Number 3, a deferral to the end. Number 4, extending the period of the loan for the amount of the forbearance. Or number 5, a loan modification. Before I get into all the different options, I'm going to go into why you need to know what you're doing when you pick what you're going to do. In this period, when the bank is taking your loan from a forbearance status to a status of back into repayment, could be a time when banks make mistakes. These mistakes would be extremely costly to you. I'm going to talk to you a little bit before I get into each one on what to avoid when you're dealing with the bank. The first thing is you cannot assume the bank's going to do exactly what you think it's going to do. You cannot assume that because you signed a piece of paper, the bank is going to do what it said it's going to do. You need to follow up with the bank. You need to call the bank after you've signed what you're going to do. You need to follow up with them. You need to make sure that what they said they were going to do, they are actually doing. The problem is, because you're not actually paying your loan, you are in danger of going into default. If the bank doesn't properly process your forbearance in the way that you want it to be processed, they'll simply say that you are late. And when that happens, even though the bank might be able to correct it later, you're going to have credit problems. And remember, credit's a big house of cards. If one of the elements is changed on your credit report, the rest of your credit could be destroyed. So it's very important that you protect your credit when you're switching from a forbearance to a current loan payment. The full repayment option might be your best bet if you have all the money. The reason for this is because the other options require manipulation of the loan and might, like I said, cause problems when the actual manipulation happens. If you simply write a check for whatever's owed, then the problem's solved and you continue paying as if nothing. If you have the money saved, your best option would be to write a check, get back into paying your loan, and move forward with your life. Remember, all you're doing is paying yourself. All the other options do is basically put the amounts of money at the back end, extend the loan, but you still owe this money. If you pay it now, then you no longer owe it. If you are trying to pay off your loan quickly, then what I would do in this situation is accept the full repayment option, write a check for the forbearance amount, and get on with your life. The next 4 options involve asking the bank to manipulate the loan in some way so you can pay back the forbearance period amount over some period of time. The big question to ask when you're dealing with these next 4 options is what happens with the escrow. The escrow is the taxes and insurance that you owe during the period of the forbearance. It's very important that that is dealt with no matter what you decide, because the escrow can be a big problem. Sometimes thousands and thousands of dollars can be tacked onto your mortgage in a way that you did not anticipate and will drive you into default. It's very important to be very clear with the bank what happens with the escrow. If they're going to put the escrow on the back end, if they're going to let you pay what you did not pay in the year or the 6 months that you didn't pay over a certain period of time, you need that in writing, you need that explained to you. Don't assume that whatever you're asking for will include the owed escrow. The escrow that you owe could be treated differently than the principal and interest payments, and that's very important that you ask the bank and you clarify this. The second option is called intermittent payments. Intermittent payments is basically taking what you owe and paying it off in a short period of time. either 6 months, 9 months, or 12 months. If you do the math, you have a $1,000 mortgage payment, you were in forbearance for 6 months, you now owe $6,000 and the current payment of $1,000. If you take that over 6 months, that means that your mortgage payment will now go up to $2,000 a month moving forward, because you're paying $1,000 from the old payment and $1,000 from the current payment. If you can't afford that, then you might have to ask for 12 months. 12 months means that you're taking the $6,000, extending it over 12 months. That's $500 a month. So your payment would be $1,500 a month versus $1,000. The pro here is that you're paying back the money that you owe and you're keeping your equity. The con, obviously, is that your payment's going to go up. So you run the risk of not being able to afford it. The question to ask is that what happens if you agree to one of these intermittent plan payments and 6 months down the road you lose your job or something happens and you're unable to continue making the payments? What will the bank do for you at that point? Make sure you ask that question, because if the bank says there was nothing else for you, this is it, then you're going to run into a situation you might go into default. So before you pick this option, be sure to talk to your bank, ask them what would happen if you were unable to complete the intermittent plan payment. The third option is to lengthen the maturity date of your mortgage. What that means, if you were in a forbearance for 1 year and you had 10 years left on your mortgage, you're asking the bank to tack the 1 year forbearance onto the end, not as a balloon, but to extend your mortgage for 1 more year. This might be a good option because your payment does not go up, your payment doesn't change, and you just basically have to pay another year of your mortgage. This actually, of all the options, might make the most sense. Because most people don't actually stay in their homes to the completion of their mortgage, the 30 years or 15 years, this option might make the most sense. Because all you're asking the bank to do is to, in essence, put these on the back end, but not create a balloon. Putting a balloon at the end of the mortgage has its own specific problems, which we'll talk about in a second. In this option, you're not asking for a balloon, you're just asking for the bank to let you keep paying as if nothing happened for a year. Of all the options which involve a repayment, in my opinion, this is the best one. This basically assumes that as long as you keep paying what you're paying, you just have to keep paying for another year or 6 months or however long the forbearance period is, and no harm nor foul, you get out of it a year later. The con, obviously, is that you're going to owe for an extra year, and for some people who have a certain specific financial plan of retirement or other things, this might be a problem. This is something that's very case specific. You need to decide when you're looking at your situation if this is the right option for you. The next option, and the one that I believe most people are going to pick, is called a deferral. A deferral is basically taking everything that you owe during the forbearance period, putting it at the end as a balloon, and forgetting it ever happened. Most people, in my opinion, are going to pick this blindly without any more thoughts. A couple thoughts on this. The pros. Obviously, it's very good to forget about 2020, put the forbearance at the end, and think about it either when you sell the house, refinance the house, or are going to pay the house off. That, in my opinion, is a very good pro. The con, and this is something to think about, is that what you're doing is basically putting a very large payment at the end of the mortgage. If you're close to the end of paying off your home, this might be an issue, because what you're asking the bank to do is put a big impediment to actually paying off the mortgage at the end. So if your mortgage is high, let's say your mortgage payment is $2,500 a month and you've been in forbearance for 10 months, that's $25,000. If you're close to the end of your mortgage, it's a $25,000 payment that you have to make on the last month of your mortgage. A lot of people aren't going to be able to do that. It's also technically a lien, almost like a second mortgage that's placed on your property. So when you're trying to refinance, it's something else that they're going to have to deal with when they're looking to refinance or when you're selling the home. It's not a big deal, but it is a separate little lien that does exist on your property. Between having a balloon at the end and extending the loan for another period of time, I would recommend extending the loan for another period of time if you're able to. Simply because what you don't want to do is set up a situation where, God forbid, you're at the end of your mortgage, you're getting close, and all of a sudden you might have even forgotten that this big payment's there, because who knows how many years are going to go by before this happens, and you're stuck with a huge payment at the end of your mortgage that you're unable to pay. The last option they're going to give is called a loan modification. Now, they're going to give you this option, and this is actually a good option if you still haven't retained your employment and you're unable to continue making the payment. Remember, every other payment here requires that you keep making your old mortgage payment into the future, regardless of what you do with the forbearance amount. A loan modification is basically a manipulation of the entire mortgage for a much lower payment moving forward. This might be a very good option if your income has gone down and if you have a higher interest rate than what's currently available, which is most people because interest rates are extremely low right now. A forbearance period is not a default. Most of the time, before you can apply for loan modification, you have to be late on your mortgage. But if you're in a forbearance, you're technically not late, but they allow you to apply for loan modification. I would apply for loan modification if I were you, because you might actually be able to get a lower payment for the rest of your mortgage and move forward. If you're unable to keep paying your mortgage at the old rate, at the old payment, then you might want to consider taking the last option and applying for a loan modification and asking the bank to lower the payment so that you can move forward with a lower payment. The pros of this obviously is that you're going to get a lower payment hopefully, and you're going to move forward with a lower payment. The cons is that when you're applying for loan modification, you need to know what you're doing. If you make mistakes in the application, it could delay the application and it could drive you into default and might put you in a worse situation than you were before. However, I think that with these forbearance programs, if you apply early enough, especially before the forbearance period ends, then you might be able to apply for loan modification while you're in a forbearance. It's a free shot. If they give it to you, fantastic. If they don't give it to you, well, at least you know where you stand and you can maybe figure it out after the forbearance period ends. But this is a proactive step. I would suggest that if you have the opportunity to apply for loan modification, you try it and see if you can get a lower payment and save your home into the future. My name is Diego Mendez. I'm a bankruptcy and debt lawyer here in Miami, Florida. I've helped thousands of people with their loan modification and bankruptcy issues. Please subscribe and like my videos so that I can continue making these videos for you and you can make the best choices regarding your home and get out of this COVID nightmare and move forward with your life. Thank you very much.